Okay? All right. So I would like to start by helping you understand what is behavioral analysis. In trading, people who are approaching trading can approach it in three different ways. Whether we speak about fundamental analysis by looking at the market for the long run, for the bigger time frame picture. These people will be mostly interested in analyzing the market through the angle of a company, if they were interested to trade equities, by analyzing the microeconomic aspects of the company, going through all the typical ratio type of analysis, whether it is about profitability ratios, solvency ratios, any type of analytics that could give them an idea whether the price of that share is undervalued or overvalued. In the case where they would be undervalued, people would be interested to make up that difference between where the price is, where it is supposed to be. So trading is about the simplest. The definition of a trading is trying to take a trade, take an entry position in the market, which seems to be either very cheap to buy or very cheap to sell. So it's about finding the level in the market where you don't see the price at its right level, at its right position. And you are looking at bringing the price somewhere down to where it is supposed to be. And trade through a fundamental analysis approach could be a good way of making money. But this approach doesn't guarantee you that you'll be making money in the next 12 hours, 24 hours, or even the next week. It is a long-term approach. And for that approach, you need to allow yourself a lot of patience and to carry a position over a lot of different change in the fundamental approach in the market. But you have such a long-term view that even though something was to go wrong for this company or for the environment that this company is trying to benefit on, even though you would still believe that this company has a chance to reach the potential of that price that you want it to go to. It is called a target profit. So you can do it like this, having a big picture where you would consider the question in which direction the market is supposed to go. And that is what we call the fundamental analysis approach. So the answer to that would be what direction the market is meant to go to. The number two approach is a little bit more short term, looking at the options of carrying a trade for something like a few hours up to a couple of months, or maximum 3 months time. For this particular approach, there is another form of analysis that exists, which is called technical analysis. Don't get me wrong, technical analysis can be added up to the fundamental analysis. You can trade based on both types of analysis, which is actually adding more value to you. Because if you have a view whether the market will be going from point A to point B, and you want to take the trade in this direction, you want to be able to time your entries perfectly. You want to be able to get in with a protection level that is a little tighter, a little more tighter than the fundamental analysis stop loss. So that stop loss level that you could impose to yourself in the technical analysis will not exist in fundamental analysis. You understand my point? That stop loss will have to be very, very, very wide in the fundamentals for you to be right. But if you are trying to play in the market in order to guarantee you some kind of reward that is exceeding your risk, that is more generous than your risk, you will have to work on your precision level. And entering with precision is the job of the technical the technical approach. Here, you will enter the question, when to enter, and where to enter. What is the right time? What is the right time, and what is the right place for you to enter the market? So the third part, the third approach that we will have, and this is where I'm getting into, is called behavioral analysis. This is, in other words, is similar to price action study. We are evaluating the capacity of the market to be intelligent, because we're trying to understand the story. So we are trying to follow that story by going through the angle of who is entering in the market and why they're entering there, why they are doing what they are doing. This is, hello, how are you? This is fundamental as a question. You know, I believe you can't make a complete analysis of what is about to happen in the future if you don't have some kind of answers into what is actually happening right now. The technical analysis approach is more on what happened in the past. And the fundamental approach is looking at the long-term future. So we have a gap here. We don't know what's going to happen into the immediate future by looking at that kind of analysis that we have, because the information that we carry to analyze the market is not enough. And we don't have something called in FOREX, for example, level 2 data, which is the understanding of the behavior of the buyers and the sellers at any point of time through their volume. What is the outstanding buy volume and the outstanding sell volume in the market at any point of time. We don't have this kind of data, but we do have that kind of information in the different type of asset class, which is called futures. Futures, we will not speak about it today. I'm just mentioning it just for the purpose of understanding that in futures we have the option to look at the very immediate present situation in the market, so we can anticipate on what will happen in the near few seconds or in the near few minutes. So we can scalp the market. Scalping is this game, is this idea of entering and exiting the market very fast. We can have that kind of possibility when trading the futures market. But when it comes to Forex, we are blind. We don't see the present. And we have to understand the market, the behavior of the market participant, without looking at the present. So I have built this program in Forex by bringing in the behavioral analysis approach that I have applied to my trading in futures. And this way, you will be able to get to the bottom line of who is entering and why they are doing what they're doing. And by combining the three, you have a better chance to check in that you want to buy for the fundamental reason that the energy of the market is going up because of what is happening at a geopolitical level, what are policymakers saying, what are the leaders' speech saying. You can also do your own, this is called macro analysis environment. You can micro analyze eventually if you are trading the stock. This is all the fundamental level for the long-term game. We can also look at the fundamentals from a shorter game perspective. And that kind of analysis requires that you understand in the last day or in the last 2 days who is stronger than the other in the market. Are the buyers acting more strongly than the sellers, or are the sellers acting more strongly than the buyers? And that is possible to analyze through a method called market sentiment. We have a way, not everyone could have access to it, but the big market makers and the banks would have an access to, at any point in time, who is more important than the other, the buyers versus the sellers versus buyers. They do send you guys a report at the end of the week called the commitment of traders. And the problem is, it's always hindsight. It's always coming when it's too late. The energy of the buy and the sell has already been put in the market. So you don't get to know when that energy is on the day-to-day approach. But there are also some websites that can offer you a kind of idea what are the buyers' likes versus the sellers, but that will not be perfectly genuine. That will not be 100% reliable as that. So I'm not going to promote that. I'm just trying to tell you it exists. You can fundamentally analyze the market intraday through the energy between the buyers and the sellers. Having said that, if you have a view that it's a good time to buy due to some fundamental reasons. Now, technically speaking, is it cheap to buy? You do your analytics. You try to understand where you stand from the grand scheme of things. So you are analyzing the time frame you are sitting on, but you also need to look at different perspectives, because only watching one story in the market doesn't give you enough information, enough support for you to believe that your entry point has the right kind of energy for the market to go up. You obviously have to check on what is going on with the high time frame. And the high time frame will tell you if yes or no, your buy is a healthy buy or not. So that is at the technical analysis level. And on the behavior analysis side, well, the good thing is if we have checked the first two, there's only one thing to do from the last point. Understanding why is it a good time to buy. Understanding who's entering at the time where you enter. Trying to understand if there's a genuine reason to believe that there will be an appreciation in the market by knowing that, you will be supported by a volume of players who are acting now as a leader, who are acting now as a follower, a courageous follower. So we will go through that today. I'm not going to cover all these, obviously I don't have the time, but just for you to know, I have covered some technical analysis concepts previously. And you're free to join me on another webinar when we will cover a technical analysis, whether it's about chart patterns, whether it's about learning or how to recognize the trend from a range. We will do this. Now, what I'm going to tell you today, obviously, will be a mix between a little bit of technical and a little bit of behavioral. I need to teach you first what is a trend versus what is a range. Otherwise, you won't understand anything of what I'm about to tell you today. So let's start with this. First of all, before I get into what is a trend, I need you to understand there are three different types of market participants in the market. You know what the market is. I can always give you another definition of a market. It's just a place where buyers and sellers mutually agree of one particular price, and people will transact at this price if they are in agreement towards that. And when the market price goes up or goes down, it is because of the energy of buyers versus the sellers. In other words, it's because of the supply versus the demand, or the demand versus the supply. How many buyers there is to wish to buy versus how many sellers selling volume there is that wish to sell at the same time. If more buyers are in, it's as simple as you need to buy, you are the grocery store, you want to buy banana, and there are just a limited number of banana on display, and you just want more of what is available. So what is available is at a certain price, but you're in a street full of other grocery stores. So you will first check on the cheapest of these bananas. Then you will buy them all. If you want more, you'll have to look for the next price. And if you are still willing to buy more of those bananas, you will look for the next price. And that's how, through an auction system, the price keeps moving up in time. And the selling happens exactly the same way. If there are more people looking at selling off their position or with their volume of merchandise, and there's a very limited amount of buyers there, well, they won't have the choice than to bargain their merchandise. They will have no choice than to lower the price to meet what the demand wants. It's just as simple as this. So looking at how the price breeds over time, I'm going to show you something. How do I get back? Yep. All right. This is the price. Okay. For those of you who have never seen a chart before, this is just a visual representation of how the price moves. Guys, this is just a visual representation of how the price moves over time. This horizontal bar here is the time. The vertical bar here is the price. So you will appreciate the price will appreciate when you see that little price here going up, and the price depreciates when it goes down. As simple as this. And over time, that means the market will move from left to right. So this is what we see. Coming back to another way of visualizing this price action, which is a little more filled up with information. You can get to see when the price opens and closes, because you get to see now the price action every 1 hour, meaning you will see one of these bars called candlestick every 1 hour of market time story. And when the hour is finished, the bar closes, and you will see a new bar starting at the beginning of the next hour, and so on and so. So, having seen that you will have a lot of bars like this of 1 hour each, you can always get to see the market story in bars displaying 4 hours of market stories. You can do it in many different time frame ways. So the story is pretty much fractal, meaning that whatever you see on different time frames, it always moves in the same manner. It moves in waves. All right? It doesn't move in stairway. It doesn't move in triangle. It moves in waves most of the time, and not just because of the nature of how the market is organized, because we are human. Can expect the price to do certain things at certain point of time, which is what we will discuss today. So, just for your own understanding, when I'm showing you this chart, it's just for you to see that the price has a certain attitude of going up in a waving manner. As you can see, the price waves up, down, up, down, up, down, up, down. And it will do the same on the down, up, and down. So of course, the question is always to know when it will stop down and when it will stop going up, and take advantage of this. Well, you will see it's not always about selling cheap, selling high, and buying low. It's pretty much about doing the opposite. You will understand later on why. The market has a certain way of acting, and most of the people trading today in the market are trading in a very human way, in a very, they perceive the market from a very amateurish point of view. If the price is to go up, they think it's a good time to sell. If the price is to go down, they think it's a good time to buy. So, absolutely, if the market was to go down, after sell, and if it was to go up after you buy. Unfortunately, it is not happening most of the time. And I will explain to you why. So before I go into what is happening in the market, you need to understand there are three market participants at three levels of time frames that are different. The number one are the big players, the ones that are generally making the market. They are the ones deciding what they want to do with the price. They have a lot of volume in the market, and they can push it to whatever extent they want. These guys are big banks, financial institutions, generally the major ones, big investment companies like Berkshire Hathaway. Yes, absolutely. The whales are these big players. So, coming to that, let me just write it. Absolutely. So we have the whales, these whales, sorry, I have it, sorry. The whales, yes, no, sir. So the whales are what? Big banks. You'll have investment companies. You have pension funds, insurance funds, mutual funds, etc., etc. You will also see in there the major corporations like Boeing, Airbus, Danone. Yeah, they trade a lot. That's what the market is meant for. Institutions. I'm just going to go through a quick definition of what the market is meant for. Sorry. Okay. I won't write it like this. Sorry, guys. Up. Major corporations. Yeah. So we have investment banks as well. All right. So let me see that I wrote it here. Right. Good. Number two. So these are the whales. We call them also in a different way in the market. We call them the real money players, because they have so much volume that when they put that volume in the market, they basically don't need to borrow any of that money from somewhere, from any bank or any financial institution. The number two will be the sharks. And these guys are called the leveraged money players. And you will see in the hedge funds, fund of funds, real estate, investment trust, schemes, and so on and so on. You have, as last, you can call them the small fish, you can call them the Nemos, you can call them the way you want. So we have here what we consider as the fast money players. The leverage money, just for you to understand, are the people who need to borrow money to look big, or as big as the big banks, eventually to be able to interact with them. The fast money players are speculators. You will find out proprietary traders, and they will be in their trading companies. Like here in JLT, you'll find trading arcades like us, and so on and so on. So just to give you an idea, in the market we have, yeah. I'll come to that. Yeah, it's a very good question. So let's start with the first one. The whales, they make the market. This is the reason why the market exists in the first place. The market is the environment where they will be mutually able to send the big flows of transactions from production to wholesaling, from wholesaling to retailing, and all these are possible. And for you to get your milk delivered from New Zealand to the shelf of the supermarket in less than 24 hours without that milk to be thrown out, it's possible because they are anticipating on the need. There's always a market that is giving you that possibility through that market and that market through platforms, basically wholesaling and retailing platforms, to make those transactions possible. So you don't see it, but the wholesales is pretty much the biggest market in the world. And they are transacting big bulk of quantity from point A to point B, and they need the market for many things. They need to hedge the risk of currency fluctuation. By the time somebody buys something to them, and by the time that thing is delivered to the buyer, only once the buyer receives his merchandise, then he gets to pay. But the thing he's already agreed to pay a certain amount. But from the moment that that agreement was done to the moment that he had to pay, the currency may have already fluctuated. So they need to hedge to protect themselves against the risk of currency fluctuation. That's one way of using the market. Market is also used for example, you buy 100 kilo of gold right now, and you have it physically, and you don't find a market, liquid enough to resell it immediately. But there's one guy who told you, okay, I'm going to be buying it from you, but only in 9 months. So you need to find a way to lock the risk for that price fluctuation. You are in agreement that that price is the right price, but you don't want the price now to fluctuate from now to 9 months from now. So what do they do, those big buyers of gold? They have the gold physically, and they are selling on a correlated market in order to hedge risk. Basically, that quantity they put on the sell side is equivalent to the quantity they buy. They do it on a correlated market, a market that is supposed to move and is designed to move in a very similar manner to the physical market. And basically, what you would need to do is simply to reverse the trade. If you were buying of that physical because you hold it, you will be selling on a correlated market called futures, for example, because you know that it is guaranteed. You have a physical quantity backed up for that particular product. So there's no risk that you're buying something virtual and it means nothing in the market. It actually means something. And you will be able to carry that trade over to the next 9 months period. And eventually the only cost that it will be inducing to you is the cost of transaction for you to perform this hedge. You will be buying something like a commission to the broker, and that's it. You have not carried any market price risk. You understand? So this is all why the market is meant for. So think about the big market for the big players, as the big guys are all the buyers. They hold the physical. And at some point they need to hedge that risk, but the market will go down against them. So what they would sell that physical on derivative markets, on correlated markets, on separated parallel markets. They can go into products like CFDs, options, futures. There are lots of possible ETFs and so on. Once they are selling on that correlated market, on that derivative market, they need a buyer to sell to. And this selling they put is a lot of quantity. Think about it. So if they want to make sure that they sell at a price that is good for them, they need to make sure there is a lot of buyers in front. Because if there is no buyer in front, remember what I told you before when I started this course? You have a lot of sellers, very few buyers. What's going to happen to the price? It's going to go down a lot. It's okay. It's going to go down. And that's not what they want. They want to sell at that price because they have a buyer at that price. And they don't want to lose on that sell. So they need a lot of quantity of buying. And they can have it by looking at where the sharks enter. The sharks are the number 2 category. They will leverage their size, whatever they have, to look 5 times, 10 times, 50 times bigger than what they are. And they will position their size in the market as if they are big. And they will be able to take the risk from the hand of the big player. They are the risk taker. Now they have this position buy against the big whale. They are exposed, the sharks. They need what? To look at the market for them to hedge their own risk, to protect themselves against that directional trade. How do they do that? They need to find somebody they can sell to. And they will not sell on the physical market because there's not enough liquidity on it. They will sell to another derivative market. They need to find other options for them to sell on. but they cannot find somebody that is as big as them. You understand the problem? And who is that somebody? Who's taking the risk for them? Us. We are at the end of the chain. Similarly, then, when you have to pay the VAT, you will be the end consumer, but at the end you pay the VAT for the retailer, but the retailer pays the VAT for the wholesaler, and the wholesaler pays the VAT for the producer. Who pays the VAT for everyone? Us. We are always the one coming in the market for what? To be the risk taker, to be the risk receiver for all these guys. So they don't want us because they want us to make money. They want us because we are the best reason for them to make money. We have to understand where we are in the grand scheme of things. We have to understand what place we are sitting on. We can't play our game, our small fast money game, playing at a level of entry that is visible from where we stand. We can't play that game. We will be too little. Exactly what the sharks are looking for, to locate us, the small fish, in order to be coming and hit us at the level where we are the most visible. The most visible level for us to enter on is what? At the top of the mountain, when we want to sell, and at the bottom of the mountain, where we want to buy. It's exactly where they know we are, because we will massively come in at this point of time. And they have to do that. Just push us a little bit more. See, if we were selling here, just hit us a little bit, so that we will be touching our limit stop. It's called a stop loss. It's called it's a stop limit order, but basically it's meant to be for you to not lose more than what you have already lost. Okay? Once they have touched that stop loss, that's it. They got what they want now. They can bring the price down. That's why you get all frustrated sometimes. You enter at levels you think are the good price, then you get out of the market, and after you got out of the market is going in your direction. And you're like, bloody hell, how is that every time they can see what I'm doing? Well, that's the number one impression most people would have. And again, you're not thinking outside the box by things like that. You're just thinking how to protect myself, because you think I'm right, but I should not choose a stop loss. That level of mind is okay, but I should not choose a stop loss. What if I could tell you the best way to enter the market is to enter on the stop loss of people like you? And not only you keep your stop loss, but you enter at a better price, at a cheaper price. So that's what behavioral analysis is for. It's just for understanding the game. What is happening really inside the story of the market? Where the amateurs are actually entering on which level they're actually entering on. And eventually, where do they get stopped out? For us to anticipate what will be our next line of action. Yes?
Do you think that the whales and that's going to make money?
I'm saying you're right on one point. The whales make all the money they want because they can see everyone's stop loss. They have what we call the level 3 data. They can see our stop loss and everybody's stop loss because they are the ones who design the market. They make the platforms. They make the clearing. They can see you. They are the servers. You understand? The way the forex market is designed is that every click of ours is going to the bank. And then the bank decides what it wants to do with it. And each bank is its own server, has its own liquidity pool. It's a bit like a bank is its own club. And you are entering as a private member. You will trade with whatever liquidity volume that is transacting through that bank, not somebody else's bank, only that bank. But the bank itself is the alpha and the omega of the market. It takes everything it wants. Now, the broker, you were mentioning the sharks. You were mentioning the sharks. The sharks have a problem. They are in between receiving the risk from the big players and not being able to find us as clearly and as easily as what they would love to, because they need to find us perfectly located at one spot to hit us there. The problem is that the big player can sometimes take advantage of that. So by the time they try to enter, they don't get all the money that we are giving them. Some of that money we share with the player. That's the first problem. Second problem is we are never going to put ourselves all at one place. Sometimes we're a little bit here, a little bit here, a little bit here. And you know what kind of energy it takes to hit with your hedge like this? You're never hedged. So there's always a risk. If the price is going against your first leg, there's always a risk for you to die or to lose more than what you can get from us, the small fish. So that's why the sharks are not making money. They used to make money when the market was less complicated. Today, with all the algorithms that are out there, all the artificial intelligence that is now conducting all these trades, they're basically not thinking in an advanced level enough for them to put all this volume. It's very difficult when you have a lot of volume to play that volume in the market. One, by being able not to be found by the big player, because you can be the victim of the big guys. You see, you are not able to move the market the way you want, and you're not able to be small enough to stay invisible, like what we need to do, staying invisible. So they are basically in between, too big to stay invisible and too small to be able to decide what they want to do of the market. The use. It's the episode since the 2000 is not only normal. In the previous phase when the market was actually on a buy hold strategy momentum from the 1950s roughly up to 2000, it was pretty straightforward. That's why we call a buy a long, because people were buying to keep the position long term, and they will never put themselves on a sell, because otherwise they would have to keep the position short term. They would take more risk in seller. That's why people were making money this way. And since 2000, well, there's been the first drop because of the dot-com bubble, which has made the price depreciate by almost 40% of the rise, of the big rise. And then after that, it took quite some time. It took 8 years before the price came back to roughly the same level as what it went to. And again, another huge drop because of the housing market bubble, which has burst in the US, which has repercussions all over the world, and which was from a debt bubble point of view, which was much more severe than the 2001. And every new short-term debt cycle will always be severe because they keep on increasing the ceiling of the debt. So that's what happened. And now we are facing this ups and downs. And the difficulty we have is to be able to have a long-term picture on when will be the next drop for you to stand by a good low level to buy and get the rise of this momentum. So now, if you want to have a good episode as a value investor, you can't stay exposed in a trade more than 8 years, 7 years. No, I'm talking about Warren Buffett, who's been in the same position since 1950. You can't do this anymore. Maximum is 5, 6 years. If you wait at the bottom of the recession and you ride it all the way during the reflation phase, or during the what we call the recovery phase, early expansion, late expansion, bam, we have to get out.
Central banks are printing so much money that they're back in the gates again.
We are always back to where we should be starting. You're right, because at the end of the day, we can only spend what we produce. And our grandparents never had to borrow money to live well. Of course, they had to live with their own means, but they could not live by borrowing from their future self, by spending more today in order to restrict themselves to spend less than what they earn tomorrow. It was not like that. Now, since the launch of the credits and more credit lines for everything, for consumption, for investment, has been more present in the market, and since now we are giving credits to pretty much everyone. It's not the problem of the credit that makes the market drop. It's what we do with that credit. If you are, suppose if you are a farmer and you want to buy a tractor with that money, and that tractor will help you crop a lot of products, and you are selling those products, you make an adding value. You have done something positive out of this money. But if you borrow money just for you to buy a big, massive HD screen or whatever, LED screen, sorry, for the new ones, and that is just for you to throw empty can of beer at the TV while watching your best sport TV channel, it's a waste. And that's exactly what most people are doing. And when they go through a recession, they have been tightening their belt for too long They are basically struggling. They want to get back into the old ways of living their life, you know. And it's like when you are preventing somebody from eating for a few days, and then you give him food. He's not going to eat slowly. He's going to start eating in a very nasty way. And that's the problem. We are just human. We always think of creating those bubbles, and there will be more bubbles because it's our human nature. As long as there is a credit consumption way of living our life, there will always be short-term debt cycle bubbles. Because it's always about the debt. It's nothing else. Since 1929. So, sorry, we moved away from the initial explanation. So you understand those three phases. Whales, sharks, and small fish. Now, obviously, if I tell you the whales, when it comes to a movement in the market, I'll show you. So there are two different phases that you can find in the market. One is called a sideways trend. See, the center of gravity of this trend is pretty much flat. Can be slightly upward, slightly downward, but there is no increasing in the value of the price on average. Okay? Now, if we were looking at the same kind of momentum, but this time there's a shift in the center of gravity. You understand what the center of gravity is? It's the energy of this market from its mean, from its middle ground here, which you see is clearly uptrending. If you were to see something visually that is pushing up like this, then you know there are buyers who are not satisfied with the price they used to be at, and they are trying to push the market with a lot of acceleration in order to get to a new level where, again, there could be an exchange between buyers and sellers at a level of price that they are mutually agreeing on. No. Simply, yes, there's a need for them to buy more than there are people needing to sell. And as the supply and demand is now getting unbalanced, more buyer, less seller. The seller are just trying to match the demand by increasing their price, by saying, okay, you want it at this price. Who wants it? Now, if you're still interested, but there is not enough volume to sell to all you guys, they will push the price up until you guys start leaving the room. And then once they have reached the level of price they wanted for the number of buyers that is left, and there is a 100% matching for that volume to the need that you have, that's it, that's the right price. But the price keeps going up until the buyers are like, no, I'm not interested. No, I'm not interested. And then whoever is left, if they want 100 banana and there's 100 banana left, that's it. You have the right price. You understand what I mean? So having seen the price going up because buyers and sellers are no longer satisfied with this price, they will be pushing the market up in order to, again, transact at that price for some time. And once they are no longer satisfied with this price, they can be shifting the price down to a level where, again, they will be settling down and transacting. So we don't know for how long those phases of transaction take place. We don't know for how long the market will go up. There's a lot of things that we ignore in the market. We have just to first organize our head around what is a trend, what is a range, and how do we recognize both. A trend, everyone has a different definition of a trend. I'll give you mine. A trend are two phases of breakups of the previous high. This is a high. This is a high. Okay? So every time you face the market here breaking this level on the upside, you have a breakout. It is called a breakout phase. You know, when something is breaking a line, and it's like when you try to break, you put a finger across some paper and you break it. It's simple as that. It's a breakout. So there are people staying by this level, and poof, there's a panic. The panic can be on the downside if the breakout is down, and if the breakout is up, the panic is on the upside, because you can panic in both directions in the market. You can buy, and if you need to close the position, you sell. in profit. If you don't close the position in profit, you need to sell in a loss. So you will panic by selling. You understand me? If you are a seller, if you are looking at making a profit, you will close that position of sell as a buy, because that buy close a sell position. If I sell something for $10 and I buy it back later at $6, I make $4 profit. Or I can choose to buy something at $6 and sell it at $10. It's the exact same target profit. We are just conducting this operation in two different ways. We can do this in the market. We can sell first and buy later. And it costs less in the Forex market to do that than to buy first and sell later. It's different in the equities. But let's talk about the Forex market. So when you expect the price to break, because here, those sellers sitting at this door are now looking at panicking. They have been willing to see the price going down here. And instead, the market at their level of entry broke. So they will be pushing the market up. How? When you close a sell position, you buy. So from that point, they will be pushing the market up because they are still standing in this zone here. They have no choice. Okay. They will do the same thing again here. There will be new sellers joining into this spot because they think the market is high and they expect the price to go down. And if they didn't get to the level of price they want, and I'll tell you they didn't get there, the market will force them to panic because they will still be stuck in this trade and it will push the market up. So when you have two phases of breakouts like this, 1, 2, technically you have the first of my 3 rules to be in a trend. One of my rules is 2 breakouts, okay? And every single time you need to have higher highs and higher lows. Okay, I'll explain to you why. So the high, the highs, the high, the lows. Second, I need to explain something that has to do with what people want to do in the market as an amateur. Amateurs, they have no clue where the price is going. What they want is simply to look at what has already happened and to repeat a movement of same amplitude as what has already happened. It's as crazy as this. Oh, I want to see at this level of price what has happened in the past. Oh, at that price was the best time for buyers to enter to make a profit of great amplitude. That means that I have the confidence to believe that again, I'll be able to support myself with a buy at the same level and make a profit of similar amplitude. That's exactly is the belief for most amateurs in the market because they have no idea what to do other than that. They can't predict the future. So they look at the immediate past. And that's exactly what they want. In this, let me just show it to you in green. If they are selling, they want to sell here in order to push the market down back to this door. You see here? Try to understand what I mean. You will have sellers entering here, pushing the price down. If there are sellers interested to repeat the same process again, because you have to remember at that time, the market was here, right? It was the highest point at that time, before it broke. You see the trend hindsight, but imagine the trend before it becomes a trend. It was like this, right? You had an upward momentum, you were at the high level in the market went down, you think it's a good idea to go in for a sell, because you want to repeat the movement of similar amplitude as what happened before, and what happens? You don't get there. The market goes up. And the reason is simple. If you try to push yourself up for, let's say, 5 stairs, 1, 2, 3, 4, 5, but instead of, from the moment you try to enter to push the market up, somebody hitting you, you had a level of energy put into the market of moving the price by 5 stairs. It's not a system trading where people are pushing like this, 1, 2, 3, 4, 5. They don't do that. What they do is, if you were to take a chair, for example, if I was to push that chair to make it move by 5 stairs, I would just have to do this. Just a simple push. And the market will be on its way to reach 5 stairs. You understand? The whole energy for the buyers to start or for the sellers to start a move is all concentrated at the start. That's how the market works. So when they push the market for creating that momentum, but from the very first moment they enter, the market is pushing them back. What is it for? It is for them to panic. Yes. And if they were aiming to push the market up by 5 steps, and they panic instead, they will push the market in the opposite direction by how many stairs, roughly? Why? Why is 3-2? If they need to close whatever they bought, and they bought for pushing the market up by 5 steps, if they close, they will move the price back by minimum 5 steps. Minimum, why? Because you don't know how many buyers there will be when you sell. But there might be not enough buyers to support all your selling. So minimum will be 5 steps. It could be more. So that's why when you see this, and they were aiming to go down, and instead now they are going up. The market should be going up for a distance minimum equivalent to the previous retracement. In other words, whatever those sellers wanted to do here by pushing the market down the same distance, that distance should be reflected in the breakouts. So the breakout should have a distance minimum equivalent to the previous retracement. Is that clear? Yes.
Are those whales?
Sorry?
The sellers pushing the market down in the green. Are those whales or?
The sellers pushing the market down? No, they are amateurs. A complete amateurs. They are doing the same thing that has already happened. If you repeat something that has already happened, you are no longer the first of its kind, the first of your generation to do it. In other words, you are not courageous. You are just trying to repeat something that already exists. You are not courageous. And a non-courageous person is exactly the definition of an amateur in the market. So we will look at this. Actually, you're right. What is a whale? A whale acts as a leader in the market. A shark will act as a follower. He is trying to repeat the movement of the whale, but not at the same price. The shark will repeat the movement that the whale has instillated, but not at the same price. He will not wait for the price to come back to the same low level. So he will try to find somewhere in the middle a chance to getting in. But he doesn't know where exactly it is. That's why he's courageous. And I'll tell you where exactly to find that entry. You will be able to get in as a shark, as a leader, or eventually, if you want, as on the last phase of the trend, which we call the non-courageous followers. The first phase are the leaders, and the leaders, you can be a leader, but you cannot be a whale. So I call them not whales, but leaders. They are where the whales enter. We can enter like them, but we can't be a whale. You understand the difference? Whales are the leaders. Sharks, I'm calling them the courageous followers, because they get to put an entry in the market. Look, if I show you, these are the leaders. The whales, okay? Starting the trend. The price is going up, and by the time it gets to this level, we will see who, but some people are closing their position. And some people are also entering as a sell for the first time. The market goes down. At this level, new buyers want to come in. People who didn't get in the first time here, who missed the chance of getting in for that first ride. And they will get in for a profit of what? Of same amplitude as these guys. They want to repeat something that has already happened. They are the courageous followers because they don't wait till the price comes down here. They will get in right in the middle of it, okay? Now, if you see these guys operating and these guys operating, these ones will be called the courageous followers. So this is generally when the sharks come in. Then the price goes up and now reach this level. Again, the price comes down. Now, what are we sitting on? A very visual opportunity to buy. Why? Because things happen already once. Things already happened twice. Now, visually, it is easy to imagine that on that level, somewhere here, if you draw something called a trend line, you will be able to get in for a third time. You see, it's not the first time, it's not the second time, it's the third time. What are the chances like that you will make a profit of same amplitude as these guys from here to here, from here to here, by entering here? What are the chances? What do you think are the chances? Do you think you can get out with maximum profit? Very difficult, huh? But you know the problem. The problem is the trend is not a trend till you're here. Why? Till you're here. In other words, this is when trend starts. The trend starts only after one break up here and two breaks up here. That's it. That's officially a trend. But by the time the trend is a trend, it's too late. You understand my point? When people tell you you have to buy to follow the uptrend or you have to stay with the trend is almost ending by the time you see it. And this is the problem. Most of the time, when you see things, it's already too late. When they are becoming visible, they are not optimally tradable. Think about this notion. What is visible, what is optically visible is not practically tradable. You need to stay in the invisible side of the story. When it's not yet visible, this is the best time to make money. Not when it's already on display. Because the natural, your brain creates efficient models. And we all having the, I'm hoping you guys are, when you are living your life, you use your brain optimally. And if you do that, you will be thinking the same, everyone. At different levels, of course, but almost the same. You create efficient models. If I tell you today, by coming to this webinar, do you remember anyone on the way to this webinar? Do you remember the guy, the lady sitting on the bench, which color they were dressing with, what nationality they were? You didn't pay attention because you created your efficient model. You only remember what you want to remember. And the market makes you remember those things that are not important to remember, and makes you forget to look at those things that are not easy to see and not easy to recognize. And these are the ones that you have to look at. You understand? So I just want to keep it simple for now. Leaders, courageous followers, and the last phase of the market will be the non-courageous followers. These are the small fish. This is us. And we want to profit from a profit. We want to take advantage of a profit for a same amplitude as these guys from here to here. And you know what? We will never get it. We will never get it. That distance here, guys, will not be as big as this one. And what's going to happen when those guys reach this level? What do you think will happen? Tell me. Huh? Yes? How? What's going to happen concretely? See on the way up? On the way up, I'm just going to highlight this one more time. Look. Here, we had some people coming in for a sell. Those guys probably didn't get out alive yet. If they have not closed their position here, when the market came back to zero, you see they were in distress, the market went against them, they entered here, the price went up, they were selling, now they are negative, the price is coming down. To give them a chance to get out, what do? They take that chance and they get out, right? Would you do that if you were putting yourself in the trade and immediately you are negative? Of course you don't want the trade anymore. You don't want to stay in it. It's natural. So what's going to happen to most of those sellers when the price comes back to zero? They close, they buy. And by buying, they push the market up. This is why you see this here, this upward phase. You get it? And now again, these guys who have entered as a sell, again, thinking this time it's the right price for a sell. And they got killed here. Some of them did not close their position yet. They want to wait for the price to come back to zero before they get out, right? But a lot of them would still want to get out. So this panic phase at the end, sorry, something disappeared. Yep, I'm back. Here, this panic phase that you see here is not only going to be these people panicking, it's also going to be these people panicking. Whoever did not yet close their position from this spot here over there will be forced to close it somewhere. And you know what they do? They wait for the last man standing on the way up. No sellers, and then at this point they're like, okay, if you die, man, I'm closing with you. And this is the last phase of the trend, when everyone panics. If I was to represent you what this looks like, it's an excess phase. It's an excess phase. You don't, sorry. Okay, so here you will see at this point of time, it's panicking, long-term panic. And what is going on here? It's a lot of buy, right? My question to you is very simple. Do you think the people buying up there are people entering a position, or do you think they are people closing a position? Closing a position, absolutely. Who would be stupid to buy at that level? Nobody sensible enough as an amateur will buy here. But this is the best buy, guys, because this is when all amateurs panic. So if there was something you would remember just for once, is when do you want to buy? When it's actually the most aggressive time, when the price goes up to give you some food, or not when everybody thinks whether it's a good time or not. It's on the EQ of people, when the people are emotionally involved in the market. It's called the EQ because people are panicking. Emotional quotient. The panic is the emotional quotient of the market. Where you guys want to enter at the bottom of a swing is the IQ, intelligent quotient. When market is going down and you want to make it go up, you're basically reversing a previous move. It's the IQ. Okay? When you want to follow a move, because this move is actually on the way to panic, it's the EQ, emotional quotient of the market. So what I'm asking you is, when is the most healthy time for you if you want to enter the market today? It is not when everyone is IQ as an amateur, because when they are IQ as an amateur, they will panic. Somebody will hit them. You understand me? You understand? You cannot play what other people play. So when the market is panicking, when the amateurs are in EQ time, this is when you have to enter, to jump in, to make your money. You have to become IQ when these guys are EQ. You have to be intelligent in the trade when they have to be emotional. You understand? This is the only good trades that are given to you when people panic, because the panic is natural. Panic will not happen. When you guys are not making money, you're in distress, you're emotional, you panic, you give up your money. This is where I take the money. When you guys are making money, when do you book your profits? Here, here, here. Sometimes you remove your TP, you don't even respect the TP, your target profit. You want to let it go more. You have greed. You want some more. So when do I enter against you when you are making money? Difficult. How do I know when you will stop making money? But I know when you will stop losing. I know where your stop loss can be. I know when you will start panicking. You understand my point? Being emotional is being visible. And that's when I come in as a professional. You understand my point?